Before we get too far up on the deep end, ladies and gentlemen, it's your boy, the Insurance Junkie, your fiduciary killer, the all-star advisor, Alonzo Hoyer, and I'm back again today. One weapon tap on your head with another episode of the Financial Advocacy Podcast. Eventually, I will go on live with them, but these are definitely gentlemen that I belong to a specific group of financial professionals called the Breakaway League. And what we do is we differentiate ourselves from regular financial professionals, financial advisors, insurance advisors, so on, because we are an elite group of agents. Yes, I do think when it comes to that eliteness, I definitely agree on some of what they said. They can really start in like another minute or two. Because look at some of the curriculum coming up, so let's take a look at that while we get back to the meeting. Week 1, course intro, why financial literacy and planning. Week 2, savings and budgeting. Why do we do the things we do? We're here today, week 3. Building credit and understanding borrowing. Week 4, insurance matters. Week 5, government plans and estate planning legal documents. Week 6, methods for planning for children's education. Week 7, retirement and retirement plans. Week 8, investments and compounding wealth. Week 9, taxes, government spending, and the economy. Week 10, maximizing Social Security and minimizing taxes in retirement. Week 11, understanding income taxes. Week 12, planning for business owners, operators, and professionals. Give them a like. Let's refresh. Okay, they haven't quite started yet. They got another minute. Let me just let them know I'm here. And like I said, I'm casting this to you, my audience, because you guys aren't exposed to these guys, except for through me, right? And a lot of them aren't exposed to you, except for through me. I'm exposed to them because, again, we belong to elite groups together. Refresh, see if they get started yet. They're not starting yet. Okay? So we have to realize that there's a lot of financial professionals out there, and they don't show you everything. The reason I like Dave, Mike, and Clint is because they give you a wealth of information. This is why we belong to things like, I belong to things like, the IRAFC, the MDRT, Quad A, which is the Association of African American Financial Advisors. Obviously, them being white guys, they're probably not going to be a part of Quad A. But there's a lot of associations and affiliations that we all belong to together. And we come together and kind of get that stuff done. My man Broke Genius is up in my algorithm with the 3 M's, the mindset, the imposter syndrome. I'll check that out in a little bit. Okay, they're not quite starting yet. Let me go back to YouTube. Notify me. Okay. I'm going to get back to playing the music until they come back. Let's do that.
I swear that intro still cracks me up, makes my day.
We're getting started.
I can't help but smile with that thing. How are you doing, Mike?
I'm good. Was absent last week. That was my first week that I missed. But here
Your
we are.
First absence, unforgivable. No, that's all right.
Yeah.
You're here.
Yeah. Well.
Yeah, go figure. And Alonzo, brother, salute to you. Glad to always have you here.
What's up, Alonzo?
And we're continuing with our theme of financial literacy, just kind of going through basic stuff. And at least I consider it basic. What's interesting is that not all this stuff is really taught. We're not necessarily given an education on these things, particularly in high school years before we need it. And I've got a little bit of specialization in some of this stuff. So this week we're talking about building credit, understanding borrowing. How does all this stuff work? Because it's not necessarily that well understood. Guys has to do tax-free TikTokers now. I don't know how to take that right now. I don't even have the app right now. I overreacted. I deleted the app off of my phone. And so I have to access TikTok on my regular browser, and it's not the same thing. So I am feeling out of the loop regarding TikTokers. And I don't know. We could talk about more current events, but I think we might wait for another week on that. We might take a break from our regularly scheduled financial literacy series, and we'll catch up on current events later. because there's a lot to talk about in that area. But let's get back into borrowing and such and I was at an event the CFP board put on, and this is like, I don't know, 4 months ago. And one of the things that they actually mentioned was that debt elimination, debt management is no longer part of the CFP curriculum. It's one of the things that they actually do. They evolve the curriculum according to their practitioners' practice focus. And they survey all their practitioners, they get the input and such, and they realize they're not focusing on this stuff anymore. And I believe that anybody that's working with the middle income and above, I mean, usually there's only two kinds of financial enemies. We've either got the tax enemy or we've got the bank enemy. And we got to be able to know how to put both of them at bay and manage both of them at different times of our lives. Usually it's one or the other, not necessarily both at the same time. Usually someone that has extensive tax issues, hopefully because you actually have good income, good assets, and all that stuff. Borrowing, you're leveraging things, and when you're leveraging it, that means you probably have a better control over it. So it's not necessarily at odds with you, but unless you're not up to date on your taxes, that's a whole nother issue. But otherwise, most families, they have issues with borrowing, bank debt, creditors, collections, all kinds of stuff. And so I want to kind of give an overview. First of all, is it still important that we even have a credit score? If we listen to some financial entertainers, see, he might tell you, credit will not make you rich. And I have to agree with that. Credit scores is a score of how reliable of a borrower you can be for the purposes of underwriting whatever you're looking to apply for. And obviously, we want that cost to be as low as possible. But you're usually getting into a type of consumer debt in most cases. But credit has far more reaching consequences. So one of those is employment. A lot of employers are going to do a background check on you. That includes your credit scores and your credit reports. How honest are you in your which is, by the way, it's an interesting two-way street on there. How honest are you in your dealings with everybody else, which also shows that if it was really that important, I should go out, defraud a whole bunch of people, use the money, and pay all my cards and everything just to make sure that I have no issues, right? That, if you're really caught in a rock and a hard place, it makes you kind of wonder, gee, if I was really not so honest, I could easily go defraud a whole bunch of people and be on time with all my bills, and my credit reports would look great.
Well, I mean,
so there's a little bit.
With being in the insurance industry, if you were dishonest, you could do a whole lot of stuff
There's a whole lot of damage someone can do. Absolutely. Which does happen out there. I mean, we could be part of it. We're advocating for the consumer. And one of the things sometimes is that consumers are pitched things with the agent's commission primarily in mind, rather than serving them and actually doing things for them. The way that positioning, I'm going to get off on a tangent here, but the way that positioning should be is that you, the consumer, have a problem. My services, my expertise, my ideas, my advice, my products can be the solution. But so many times, I was talking with Jim Ruda about this yesterday. Jim says it like this. He says, many times for agents, I have a problem. You, the consumer, are my solution. I don't have any money. You have some. And I want you to get your money out of your pocket and put it in my pocket through the purchase of a financial product. And so it's just backwards on that. So ethics is important. Even if your credit is shot, at least it might say you're an ethical person. You might have an income problem, but you're an ethical person, that you're trying to be on time with everything the best you can. But employment opportunities, the ability to rent an apartment, your insurance rates, especially for auto insurance, especially for term life insurance. They're going to check all that stuff. Permanent insurance, not quite as much, mainly because there's far more of a premium going into it. Therefore, they have a little bit less at risk, a little bit. So all these things have ripple effects, so that if we're not taking care of our credit, it can wreak havoc in our lives. This is a far different world than what it was, before I was born. Let's just say 50 years ago. 50 years ago, if you had a job that someone could verify, why wouldn't they rent to you? Well, now they look to make sure, have you ever missed payments to a landlord ever in the past? I mean, I was renting an office and they wanted to do a whole credit check and everything to make sure that I would be on time with my payment. I'm like, really? I'm renting an office and it's month to month. I mean, if I don't pay it, you kick me out. And it's only an office. It's not like I'm going to do major damage, even if I wanted to, right? If I could really wanted to trash that place, well, I might involve paint, involve knives, right? I mean, you could really do a number, as you've seen on some of these foreclosures, right? So people, when they're foreclosed on, they make a mess of that whole place. And landlords, I know they want to protect their interests. They want to make sure they've got someone of character in there, that they're going to be on time. They're going to take care of their property. I get that. But sometimes I just wonder, like, really? I mean, all you got to do is kick me out, right? It shouldn't take much. But I don't always understand why they have to do what they do, but they do what they do. Um, in addition to those credit reports, there's other kinds of reports, such as check systems. Now, I'm speaking as a former banker. I used to open bank accounts, for now a national bank. I think they were primarily regional before. And we check with a company called Check Systems. And Check Systems is a reporting agency that will report if you've ever inquired for opening an account, and if you have a record with Check Systems, have you abused an account in the past? Has an account been closed out with hard losses? So what I mean by a hard loss is that you wrote a check that was bad and it drew the account negative, or other abuse of the account. Not necessarily it was all bank fees. So let's say you overdrew your account by $5 and accrued a bank fee of $35, which is still crazy. And then it keeps accruing fees per day. The bank fees are soft fees. That really doesn't apply as much. It's the hard fee. What was the real loss to the bank? And if it was a certain amount or higher, then it gets reported to Check Systems. And until you get that taken care of, you can have a hard time opening a bank account. And one of the things that I remember, John Savage, old-time insurance agent, he passed away in 1991. He says the number one financial tool you need in a financial plan is a bank account. And there are other insurance products that can be offered and sold to people who are what we call the unbanked. They don't have a bank account, but they have a debit card, right? They've got the green dot card or whatever else, or maybe government benefits card. They can still buy other kinds of insurance, but they can't get the stuff that we do necessarily. Mike, you probably know a little bit more about this, because I think a lot of the Medicare supplement market or Medicare Advantage might be part of that. And definitely there's certain final expense products that work very well for those kinds of for those kinds of people that don't necessarily have a bank account, but they have other government benefits cards or prepaid debit cards, whatever that is, right? So it's not like they can't be served, but you can't get the good stuff without having a basic requirement of a bank account. And
even in the final expense space, most insurance companies want you to have auto deduction from your bank account. That's the most reliable form, right? It shows that you're reputable. It shows you can maintain a bank account, all those things. And, there are some final expense carriers out there that will do some of these other programs, but generally they're going to be the more expensive ones. And they're more of, they take more of the at-risk, I guess, customers, you could say. So you're going to pay a premium to have that kind of a company that'll be willing to take something than a monthly auto draft. And especially for Medicare stuff, they'll, depending on the plan that you have, you'll need probably automatic deduction out of a bank account, or some plans will allow you to deduct the premiums out of your Social Security benefits check. So, but
which that would be far more reliable that way. Just have it come right out of the Social Security benefits. But yeah, if you to get the good stuff, you've got to have a bank account. If you don't have a bank account, you're in. And in fact, if you remember 2008 or what, we talked about the subprime mortgage market and such, and all that erupted. Well, in a way, this is subprime clientele for these kinds of programs. So there's a certain kind of a category, and you don't get the best stuff out there, which probably also means, and it's not hard to believe this, it probably also means that if you don't have a bank account, you probably don't have great health, because you're probably not taking good care of yourself too. there's a certain stigma, and whether it may be true or not, there's a certain stigma about that, which is why they do a credit check on a lot of these insurance programs. Alonzo asked a great question. Would a vector go on one's credit report? I do not have that knowledge.
So
a vector.
Yeah, I was just going to say, so for people that are unfamiliar with what a vector is, we should clarify
Like, what
that.
the heck is that? I mean, so like in banking, we talked about the check systems report. That's unique for opening bank accounts. Well, a vector is whenever an insurance agent owes money to an insurance company, and it's not being paid on as agreed. Okay, they don't have an agreement in force or anything. You're not making any payments, and therefore it's reported onto a vector type of a credit reporting system, where if they're contracted with other companies and or if they're looking to get contracted with another company, this shows up as a vector 1 report that shows that you have a record. They don't make the decision whether to contract you or not. It just means you have a record, and that means you're more of an at-risk agent to do business with. That's the only thing that it means.
And for agents
they
that
can still override that, but I wouldn't necessarily override that unless I don't know.
For agents that are looking to recruit, because a lot of these IMOs and other companies push recruiting. If you recruit somebody and they leave and they have accrued a lot of debt as their upline, you now become or can become responsible for that debt. So who you work with, if you want to be an agency owner or a recruiter on the insurance side, is very important.
It all rolls up.
Yeah.
And that's one of the reasons why I am very hesitant and so far have basically refused any idea of recruiting agents. I defer that to other people. I direct other agents when they're asking me those kinds of things. But no, I do not directly recruit. Not at this time. I might change my mind in 5 years or so, but not at this time. I don't want to take that on. So Alonzo, thank you for live streaming to your audience. Rael, salute to you. And yeah, no income, no job loans. That was the prime market, the subprime market of those things. So, and there's a lot of other issues that can affect one's credit, whether our fault or not. And those things, it is what it is. So foreclosure, that's obviously on a home, repossession of a car, can't make your car payments for 2 months. You thought you had a problem getting around before. Now you got to get good at walking. Judgments and liens. Now that could happen out of divorce. That could happen out of, if your credit card is a certain size debt that gets charged off, the lender can still put a lien on you or on your property to say that if you can't sell your property until this thing gets paid off. I still think it's funny. I've got an old lien based on a divorce and it still hasn't been paid off yet. Whatever. About 10,000. No, 13, whatever it is. And, it's going to chase me a little bit. I have to disclose it. It's not a big deal. At some point I'll pay it off, maybe, if I feel like it, But anyway, but these things happen against your property. There is bankruptcy and consumer credit counseling. Now, I had someone that I knew a long time ago reach out to me, seeing some of my posts and such, to realize I know financial services stuff. And she felt that she was getting behind on all of her payments. She doesn't want to lose her home. I'm like, well, what are we going to do? And, I mentioned, well, there's bankruptcy, but it depends on everything. It also depends on what she was doing for her work. I also said there's consumer credit counseling. And they also said everything that you're going to read about consumer credit counseling, they're going to say it damages your credit. Guess what? It's already damaged. Okay. If you need consumer credit counseling, your score is probably already low. It also means you're probably not going to be able to get any new debt. Darn it. You can't get it now anyway. So it's funny how some of the logic out there is, but the idea of consumer credit counseling is a government program, and you can look up in any state, and you can look up basically federally approved or state approved programs, and that's what you want to do. You don't necessarily want to go through debt settlement, although that's another option. Debt settlement is where you settle your debts for pennies on the dollar. Sounds great, but if you're ever applying for jobs or you're in the insurance industry and it says, have you ever had a compromise with creditors? It's a disclosure. So that's one of those things, because you're selling it for a lot lower. Alonzo, I used to work for National Debt Relief. I was with them for the first $50 million a month. Whoa. And I'm pretty sure that's not $50 million charged off. I'm sure that's 50 million recovered. That would be my assumption of reading that. So there's many ways to help get ourselves out of the situation without losing your home, without damaging your credit even further. What's interesting about bankruptcy as well is that once your bankruptcy is done, everybody wants to lend to you, because by law you can't declare bankruptcy for another 7 years, so they know they've got you for a while. So it's not the life sentence it once was. It's kind of the same thing with divorce. Used to be, oh man, you got a divorce, and it's like you're scarred for life. You know what? It's not the same thing anymore. It seems like divorce seems to be far more normalized now. It's not the same stigma it once was. Same thing with a bankruptcy. It's a little interesting.
And
Let's see,
that
what
leads
else?
to a whole other bag of issues with
Oh, a whole
that.
lot of other stuff. And I'm not sure we're going to go down that rabbit hole right now. But now, IRS audits, if anybody might know, Alonzo might know, but IRS audits may not damage your credit, may not necessarily be reported. But if you're past due with your taxes, that can be shown up on your credit reports. Past due child support, that can show up on your credit reports. And again, each, depending on which credit reporting agency you're looking at, was it TransUnion? Always sounds weird when I say trans anymore. But anyway, TransUnion, Equifax, and Experian. Those are the main three. There's other ones out there, but the only main three that seem to really matter are those three. Medical bills certainly have in the past been reported and been the cause of many bankruptcies. I think California just passed a bill, I think it was this past year, where medical bills, medical collections are no longer going to be reported to credit bureaus. So I think that's a good thing in the fact that, you need life-changing surgery, you got a heart attack, whatever it is, and you don't have insurance or whatever. Well, here in California, you better have insurance. They mandate that. But even if you don't, and all these things, because medical institutions have to treat you. And they are a for-profit institution, meaning that they've got to make money.
Well,
They do have their charitable arms and everything, but they've got to make money. They are a business. Now, they're not in the business of trying to prescribe anything that you don't need, but at the same time, they're going to help you. They've got
right. So let's clarify that here for a second. So they have to treat you by law if you show up to the emergency room or someplace like that, but
Right.
they only have to stabilize you, right? So they don't have to provide ongoing care legally. They have
That
to
makes
get you
sense.
stable, right? So if you show up at the ER and you're having a heart attack, right, they have to treat you and get you stable and get you back on your feet and send you on your way. Now, after that, they're under no obligation to treat you unless you have another emergency episode or something like that. And but yeah, so like if you just show up at a doctor's office, they have no obligation to treat you.
Correct.
Right? It's only in an emergency situation.
And these huge medical bills, they're going to come from hospitals, not from the doctor's office. So, the doctor's office, you're going to pay your copay. You're going to fill out the forms. They're going to see you. You're going to do it. Whatever a copay, of course, assumes that you have insurance, or you're going to just pay the office visit out of cash, whatever it's going to be. But you're not going to get the huge, $175,000 medical bill because you saw a doctor. You're going to see that because you went to a hospital and they determined, oh, you're having a heart attack. It's time for your quadruple bypass or whatever it's going to be.
Right. And of course, the doctor, if you don't pay, once the doctor takes you, even without insurance, if you don't pay, the doctor could always refuse to see you in the future due to non-payment.
Right.
So,
true.
There's a little bit of difference there, just so that we're making everything clear. Because, yeah, if you show up to the emergency room with an emergency, by law, they have to treat you, but they don't have to necessarily provide ongoing care once you're stable.
Right. Exactly. Which ends up being a shift of the costs back to the government. Because if those things don't get paid, if they're not covered by insurance, yet those services are performed, now it's a cost shift. And, that's one reason why sometimes hospitals close. They didn't quite manage those things right. And we're not going to talk about society at large. We're talking about how does this apply to us individually. So Alonzo just mentioned that tax liens are more apt to show than the audits. Agreed. But the IRS charges daily interest. No surprise there.
Well, hey, maybe we won't have an IRS soon. Who knows?
That's current events. I don't know what to make of all that. We'll see. Building credit history for the first time, the college years can be a great time to build credit history. And what's interesting is that even without a job, you could get a starter credit card. And I know this because I used to, be at that larger institution, and I went to a community college. We went there to, of course, open checking accounts, savings accounts for those that wanted them. And it's interesting. The community college said, well, we don't want you marketing credit cards. Well, that's nice of them to think and believe that. But if a consumer ever asks for credit cards, by regulatory law, we are required to provide it. Oh, darn. I sold quite a few credit cards back then because of that law. Granted, I'm always advocating for the prudent use of these credit cards. Don't have more than one, kind of a thing. Take care of it. But the reason that the banks will issue them is because they assume that your parents are going to help you. You get into a bind, they know they're going to help you. And you get these starter cards for like $500 up to a max of maybe $1,000. Of course, that was 25 years ago. Geez, it's been a while. So those limits might have gone up by now for these starter credit cards. But the good news is that you can build a credit history, get something reported. And there's some rules of thumb, and I'll go over that here in a second, but it gets you started on the path. And there's nothing wrong with doing that if you're doing so responsibly. So some rules of thumb on this is, the first one is keep your overall credit utilization below 30%, which generally means you have $1,000 worth of credit. Don't carry a balance of more than $300 month to month. 30% or less is good. That means you're not utilizing all of the credit available to you, which makes you more of a preferred borrowing risk, which generally means you're going to have a higher credit score. And that's across all lines of credit that you happen to have. So if you've got, I'll throw out a big number, you got $25,000 worth of credit. I can't do the math in my head, but keep it down to 30% or less. Once you're approaching 30 to 50, your score is going to go lower a little bit. Once you're past 50% or more, your score is going to go down much further because now you're utilizing as much of your credit that you have.
So
when
the
applying for
the number you're looking for is 7,500.
Thank you. See, when I'm talking, I don't want to do the math. I can bring up the calculator, but I don't want to pause. So I appreciate that. Thank you, Mike. 7,500. Yeah, close enough. All right. The next part is that when you're applying for credit cards, what most people may not know is that every time that you apply, and we call it a hard inquiry, meaning that you've actually submitted an application, it records that you have applied for credit. And it records it based on whichever bureau that bank happens to check. And they might check more than one. So if you apply for a credit card, it's going to show up that says you're looking for credit. On this date and this time, you applied for a credit card. And depending on whichever bureau it is. Now, why is that important? Well, that's important because if you decide, I'm going to apply for a whole bunch and see what happens. Well, it's going to show lenders that you're desperate for credit. That's what it looks like. You've got 10 inquiries in 30 days. You're desperate. That's the interpretation of that. Now, these days, there's more of a loophole to that, more or less, where you do a pre-qualification screening. And a lot of credit companies offer this. So you can see, it's like, see if you're pre-approved. That one's great because they do not do a hard pull. They do a soft pull. And what that means is that they're going to check your credit kind of like a scan, but yet they don't say it's an official inquiry. And they'll see, hey, you know what? You'd be approved for $500, $1,000, whatever it is. But it doesn't affect anything. And you can just find out, would I be approved or not? And now sometimes you could be declined for that type of an application, and yet you might still be approved when you do a formal application. So you never know. some lenders, you kind of get a sense of, you can actually do some research on some credit discussion groups. I was actually a moderator on one of these 20 years ago. I'll share with you a post from one of those because it's still there. Yeah, my information on this comes from outside of CFP, CLU, CHFC. They don't cover much of any of this stuff.
PFD.
Yeah, BFD. Shut up. Appreciate that. Okay. Let me go through some other things before I get into something that's slightly more elaborate. But do we all understand? Oh, here, Alonzo, my favorite participant here. It's been recommended to apply for multiple things in a 7-day period. That depends on what you're applying for. And such. So if you're applying for a credit card, you can apply for multiple things for the same lender. So you're on Capital One's website. You want to apply for 3 different credit cards from Capital One? Go for it. It all counts as one, which is what he says there, as long as it's for the same inquiry. But it has to be the same lender. If you apply for, I'm going to make up some names here, Provident Bank, I don't think they're around anymore. This is how old my thinking is. First USA Bank, Wells Fargo, Bank of America, all these are separate lenders, which means they're all going to pull a different inquiry. And so that all is going to count as separate inquiries. So you got 4 to 10 or whatever it is in a 30-day period. It's like, oh my gosh, you're looking all the time. No one's approving you. Therefore, you might get some really bad, what I call subprime offers. Was it First Premier Bank has some of the worst credit terms, like a $150 setup fee and a $90 annual fee and the fee for the other fee. And you never know. And granted,
PPP.
yeah, well, but remember, Trump said all interest rates are going to be 10% or less, right? We haven't heard anything about that since the campaign trail. We'll see what happens on that.
It's only been a week.
Yeah, 9 days. That's right. I was going to say 2 weeks. No, we're not there yet. Yeah, we'll do a current events thing later. I'm also concerned that most people don't understand credit card interest rates. That most people don't know that there's 3 different interest rates on a single credit card. Most of the time, anyway. You have your purchasing rate. When you're purchasing something, you're swiping that card through for something, there's a particular rate. And you might have a promotional rate for the, at the beginning of it. You might have 0% on purchases for 6 months, which is nice. But then you have a balance transfer rate. You're using that same amount of credit to pay off another credit card. And maybe they're saying, here's 0% for 12 months, which is a beautiful rate. Then you have your cash advance rate. And the cash advance rate is a whole nother rate. And depending on how you're using your credit card will determine how much in fees and interest that you're paying. And what the other part that most people don't necessarily realize is that how are payments applied if you have different kinds of balances on your credit card? So if you have 0% purchases, 0% balance transfer, and you've got $1,000 cash advance that you did, and it's supposed to have a balance on everything, the payment is going to apply to the lowest interest rate first, so that the bank can make more on the higher interest rate on that other balance. So they're going to stack it for their favor. So someone said, we could easily say in a financial discussion with a client, what's your interest rate in your credit card? I would probably know far better if that person's really financially astute, if they say, which rate do you want to know about? And I said, well, it depends on how you're using your card. So, someone who's paying that much attention, it's pretty rare. But usually you've got 3 interest rates on a credit card, and that's how the payments are applied to it. Obviously, credit cards are a huge convenience. I don't tell people to cut up your credit cards, which, by the way, almost does nothing unless you actually close the account. But which, something else about credit
can negatively affect your credit if you just keep closing accounts.
That's right. The older your credit card is in good standing, the better it serves your credit reports. In fact, I remember from these discussion forums, the ideal is you want at least 4 trade lines reported for at least 2 years to build up a decent kind of credit score. Now, granted, what's that really serving? Well, it's showing that you can be responsible for more than one credit line. And it's showing that maybe you can be responsible for multiple kinds of credit. So maybe a car loan in there or other installment loan. whatever else. In fact, now I think you can even have your rent. If you're renting an apartment, you can have your rent payments included on your credit report just to show that you're on time with your rent payments. There's many different things, but the idea is to have multiple things reporting in good standing that can help you to show that you're a person of character who's responsible for all of your bills.
Which
All
is
of that
why,
combined.
if you ever have any financial entertainer out there telling you that you should not use credit or have a credit card, you can just laugh at them, because if you ever need credit and you don't have any, or you keep closing your accounts, you're never going to get credit. And I don't know, or it's going to be very hard to get it. Your rates will be much higher, and you'll have, look at it as an adverse risk, basically, because you don't have any
Right.
credit history or very little credit history. So you use your credit wisely, right? Don't overspend. Don't, maybe get a credit card and put gas on it, or your whatever heating bill or something that you're going to have to pay every month anyway, where you're not going out and just saying, oh, I want to buy tickets to the Lakers game that are $1,000, right? And so I'm going to put it on my credit card, and I don't know when I'll pay it off. But put things on there that you're going to use anyway, and build up your credit and budget that in there. And then, that way, when you do need credit, let's say you want to start a business, or you need a loan for a house, or who knows what down the road, you have a credit history, and you're going to be able to get the line of credit that you need, as opposed to being an adverse risk and having no credit history. And especially if you go to buy a house and you want to get a loan, they're going to look at all of that stuff. And if you don't have any of it, as some financial entertainers would tell you, you're going to have a tough time getting a mortgage. Yeah. And I don't know about you, but I don't know too many people that have $300,000, $400,000, $500,000 laying around to pay off a house all at once. I don't know what the median cost of a house is right now. Call it, $350,000, maybe $400,000, somewhere in that ballpark.
Maybe in your area of the country.
Yeah, I mean, I'm just talking about overall, right? I mean, every area is going to be different, right? But throughout the U.S., let's just say it's 350 to 400, right? I mean, you have to have credit, and most people also don't have money to pay cash for a car. Sure, you might be able to save up for it, but if you want anything that's dependable, reliable, somewhat new, especially in today's car market, you're going to need a minimum of 10 to 15,000, probably, somewhere in that ballpark, with decent mileage on it, that's, hasn't been in a wreck or something like that. So, this idea that you don't need credit, or that credit is bad, is totally erroneous and false. But using credit to your advantage and to benefit you can be a good thing. You just have to, use it responsibly.
Yeah, credit has a cost, and that's probably the only thing that the financial entertainers talk about is the cost, and here's how long it's going to take you to pay it back. And you know what? There's other costs of not building credit wisely. Now, Alonso's got this question here. Question from his audience. I have 7 cards. Is that bad? And I'm going to say it depends.
It depends.
Word phrase. We keep saying that damn thing. 7 cards depends on how they're used.
Yeah, and are you opening cards to pay off other cards, and are you just recycling debt through these cards, or are you making payments on time? Are you opening one, another one because you've maxed one out, and now you need another card so that you can have more credit to pay bills, or whatever, So it depends. If you have 7 cards and they're for different things, and you use them and they're paid on time and you're responsible with them, having 7 cards might be perfectly fine.
Well, and literally, we're talking about a house of cards that all you need, and once your income falls apart, so does all of the credit you deliberately built. It could all fall apart once your income becomes interrupted, which brings up the idea of what? In case you become disabled, don't we need disability coverage to make sure we keep the paychecks coming in, particularly when we are unable to work due to disability or illness? We want to make sure we can keep that income coming in.
Yeah. So, and about that 7 cards thing, I would say whatever you do, don't close a bunch of them because that'll hurt your credit, right? So
Yeah.
don't just close them, but try to use them here and there and keep them active so that you're cycling through them, so that way you're not just sitting idle or whatever for a long period of time, 6 months or whatever, and try to keep put your Netflix payment on one and your whatever on another, something that you're going to pay off every month. Just keep kind of a monthly thing on there, so that way it's showing that you're using the card and that you're being responsible with it. But certainly whatever you don't just go out and close them all, because that'll be a bad thing as well.
Unless, and because here's the thing, credit reports and credit scores don't pay you. And if you're going to continue to abuse them, no one else is going to do this for you. So if you're going to abuse it, close them out. And that's because of financial disciplines and things like that. And believe me, I've been there. And by the way, going back to the idea of whether you're paying a couple grand for Lakers tickets, look, if you haven't messed up royally with your credit, have you ever become an adult yet? I mean, I got my first job at the bank. I could say this 24 years ago. This is about the vulnerability we talked about last week with Kevin, right? I don't mind sharing, some of the mistakes I made. But when I took that job, I was promised more or less, or no, I was not promised. I was assured. That's a different word. I was assured that I would make this $5,000 quarterly bonus just for working at that bank. And I thought, you know what? Okay, that sounds good. And me being so
Young and
ignorant
naive.
on things, young and naive, I was 23 years old, and I got myself approved for a $5,000 credit card. I'm like, $5,000 credit card, $5,000 bonus, not realizing it's going to be fully taxable, be taxed in half anyway if I ever got it. I went out and I bought a $3,500 clarinet back then. That was dumb. So one of the things that I learned as a key lesson is don't count on future income to make purchases today, especially larger purchases. Don't do that. Wait till you actually have the money in your hand.
And especially as an
you don't
insurance
learn these
agent,
things.
especially as an insurance agent when you're taking advanced commissions.
Oh, that leads up to the vector thing we talked about earlier, because from insurance agents, remember, that's a loan from the insurance company. And if we look at our contract, we actually have an interest rate that if those payments from the consumer aren't made on those policies, we get charged back, and we're charged interest on that for whatever that remaining balance is. So yeah, it's we're in the risk management business. We need to be able to identify the risks within our own business, let alone the risks of our own habits. All of that all goes together. Okay. Moving on from credit cards, there's also loans and lines of credit. So let's talk a little bit about that, because loans are generally over multiple years. Let's look at a car loan, right? We're going to borrow 20 grand for a car loan. We wish there was a 20 grand car loan. I mean, any car if you're buying a brand new car, you don't want a $20,000 brand new car. You need something more. I know cars today are kind of junk, but you don't want to put yourself in an even worse position by having even more junk by not spending enough on having a good car. So let's suppose you got a $30,000 car.
Barely above junk.
Barely above, yeah, 30, which is crazy, right? Which is why if you have cash, pay cash, get yourself a nice, good quality used car. Now, I've got my Lexus 17-year-old car this year. Drives like a dream. I paid 12 grand, no, 13 grand. That's including the taxes and everything back 4 years ago. I put a lot of money into to get rid of all the warning lights and such, but I put 50,000 miles on it in the past 4 years. The thing drives amazingly. You can't buy a new one for the same amount of money. New Lexus LS, which is not worth owning either. In fact, there's a YouTube video of
it's like $120,000 car.
It's a $120,000 car. And the thing is that they test drove the new Lexus LS, compared it to the 2009 model, which is only 1 year newer than mine. And they determined that the used one was the bargain of the century, or the bargain of the world. They said used is the best way to go on this one. It's so much better.
It is very nice. I've ridden in it. You gave me a ride to the airport one time. Yeah, so I know that it is a nice car.
I've made it better since then, by the way. I made it better since then because I got it's kind of stupid. And I'm going to go off on a slight tangent. I got myself a gas cap. Okay, $10 gas cap because the old one it
So
was
your check
original.
engine
Sure.
light turned off?
No. The check engine light never went on,
Oh,
but it stopped clicking when I would fill it up with gas. I'm like, you know what? I want my gas cap to click. There's got to be something with that. I don't know what it is. And then I realized when I got the new one, I put it in. I'm like, I wonder if that would help with the fuel pressure. I'm telling you, it does because in normal mode feels like my power mode, and power mode shoves me back in my seat. I'm like, I unleashed something here in this car just because of a damn gas cap. So you never know, but that's of course if you can pay cash for a good quality used car. Do your research, know the nature of the car you're getting into. There's lots of stuff on YouTube for just about any car. I would say beware of German engineering. But Alonso loves his Mercedes, and I don't knock you on that. Just that the older
yeah.
they get, for German engineering, over 100,000 miles, you've got bigger problems. So that's the thing. Know the nature of the car you're getting.
Yeah.
But
If I
with
were
loans
to
versus
get a Mercedes, I would personally. This is the only time I would lease a car. Is I would lease a Mercedes or a BMW, and then once the warranty's over, get rid of the thing because that's when the
or the
real
lease is
bills
up.
start coming. Yep.
Yeah.
That's the only reason. Only way to lease a car is if it's going to be an expensive European car. Go ahead and lease the thing, and then give it back and let somebody else deal with the with the out of warranty issues.
So, but the thing about going into debt for a car, and here's the thing: everybody says, "Well, a car is not an investment," and you're right, it's not an investment. But if you don't have a car, can you do anything else in your life? So,
Right, and depending on what the car is used for and what your work is, it could be a write-off as well.
could be. But of course, if you're using your car for commercial purposes, you need proper insurance
Commercial
on
insurance,
that
yep,
car.
yeah.
So there's all kinds of factors that go into that. But even if you, think about whatever employment you have. Can you get to that employment without that car? And quite frankly, even if you could, how many hours on the bus or how many hours walking is it going to take for you to arrive at your job? And even then, does anybody want to be near you after you've been walking all that time? And the bus, it depends on how clean your public transportation system is. Basically, a car is an asset, but sometimes that asset is a liability. And I don't mean that it's an asset on its own. It's an asset because it helps you earn money in whatever you're doing. It is not an asset in and of itself. But without that car, you might not be able to do anything else. So
Yeah, I mean,
keep that balance in mind.
It's a depreciating asset, right? So it's
in the vast majority of cases. Yeah. Granted, we recently just came out of an interesting used car market, and
unless it's you get something like that where you have this weird thing during COVID or whatever where nobody can find cars, or unless it's a collector's car and you're buying it for that like investment.
Generally speaking, was it when we had the chip shortage of cars, and of course now we also have we've had the electric vehicle mandates and other things, which is creating more demand for older cars because they're seen as more reliable. They're built better. We talked about German engine. Older BMWs are built far better than the new ones are. And I don't mean for performance capability. I mean for reliability. Like they have plastic radiators rather than metal ones. There's different things.
The new ones do.
Yeah, the new ones. Yeah.
Yeah.
They're not the same. So being able to get something that's built better, you go older, and
it's still going to
hopefully
cost you a lot when you pull it in the shop, but at least it's built better.
yes, but it'll last far longer if they're well taken care of. So everything, it depends. I swear we're going to rename our podcast. It depends.
We have talked about that, the It Depends podcast.
I know. Maybe we'll do it as an offshoot. I don't know. Alonzo asked, how do IBLOCs factor into the lines of credit? Not too many people even aware of. I assume we're talking about insurance-backed or infinite banking lines of credit. I have a segue into that. I will get to that. But here's the thing about infinite banking and using your cash value life insurance as a source of capital and borrowing against the policy. The neat thing about that is it's not reported to credit bureaus. So the neat thing is that it will not impact your ability to get new loans, but it does not report any payment history at all to help you build credit. So it's not for the purpose of building credit. It can preserve credit. If you got laid off and you have enough cash values in a life insurance policy, you can use that to either make your payments or pay off all of that other debt
Right. Of course,
as needed.
you still have to be careful with that too, because you don't want to overload the policy and lapse the policy and create a taxable event. So that's another side issue. But using your cash value life insurance responsibly in certain situations is definitely beneficial. And like you said, there's no reporting to credit bureaus, and there's not necessarily a repayment schedule either. So you can,
which is a double-edged sword on that one.
Correct. And that's why you have to, if you do that, you have to monitor it and make sure that you at least make some payments on it to keep the policy from lapsing. So that, because you don't want the policy to lapse. And that's where the problem can come.
So Alonso's clarifying for me, not talking about infinite banking lines, but thinking about insurance-backed lines of credit with Bancorp. And Bancorp, I did a webinar with Bancorp 2 years ago now, I think. And the thing about Bancorp is that they take a position on the policy. There's a collateral assignment for them for whatever you're being borrowing against, and their interest rates are going to differ, are going to be largely more on. I think it's the London Interbank lending rate. I can't remember. LIBOR. I can't remember what the thing is. They're going to make a spread on it, and their interest rates and their terms might be a little bit different than getting the borrowing directly from an insurance company. So it just depends. The neat thing about doing it from an outside institution rather than the insurance company is that for the insurance company, they get to keep a healthier balance sheet. In fact, on the channel somewhere, I've got a whole thing, infinite banking misrepresentation. And John Owija talks a lot about over borrowing, over lending, and that being a run on the insurance company more or less, and that it's a problem for them. Quite frankly, if it really is a problem for them, then they're not pricing their loans right. And I'd say that's the insurance company's fault. If they're going to let themselves be abused that way, that's on them. Sorry. So either one. But as far as the insurance-backed lines of credit, those are also not reported to credit bureaus. And if you think about it, there's no reason for them to be, because they're double secured. They're secured by the cash values while you're alive. They're repaid with the death benefit when you pass. So where's the default?
Yeah, there's virtually no risk for the insurance company, right? Because you're borrowing the cash value that's already built up in there, and if you were to pass away, it's just subtracted from the death benefit plus any interest, right? So
exactly,
there's virtually no risk to the insurance company on lending money based on cash value built up inside of your life insurance contract.
Right. Exactly. Now, let's get back on topic, because we're already at 50 minutes in and haven't touched on the other half of what I was going to talk about. But as far as loans versus lines of credit, loans are amortized over a period of years. And what they do is they structure the interest to be heaped more up front. And so you're going to pay more interest than principal. And then over time, it evens out later on, where you're finally making more principal payments than interest payments. And it's not good, bad, or indifferent. It's just knowing how it works. Knowing that when you've got a 5-year loan, or actually with the way car prices are, you could have up to a 7-year loan on some of these new cars. And I swear, if you're going beyond 5 years, you better have a reliable car that you're borrowing to have those payments be that low over that period of time. Because the only reason to go beyond that much time is to make sure the payments are affordable. And here's the other thing too that some people do is they have to trade in their old car because it wasn't so great, and then they take the difference because they're underwater in the car. The car is worth less than the loan, and then they roll that amount into the next loan, so they have an even bigger payment on the next car. And imagine those people, if that car gets into trouble, it's just it spirals out of control.
I've known a few people that do that. And it's almost like a habitual thing. And once you start doing it, it's difficult to get out of.
It's almost like the cash advance places in some ways. But, you get started with that. You need a little bit of help, but then you got to pay them back. And you know what? I need that money again. And you go back, and you don't get yourself out of that cycle. It's the same kind of a thing. But one thing about amortized loans, that they heap the interest up front, whereas a credit card or line of credit is usually simple interest. Whatever the balance is, they're charging it based on the current rate, whatever it is. Now, that doesn't mean it's going to be a cheap rate, Could be. It depends. You got to look at what you've got. One of the things is looking at the Truth in Lending report. There's always a Truth in Lending disclosure, especially on loans, mortgage loans, car loans. They're going to tell you, okay, you're borrowing 20,000, but you're going to be paying us back 28,000 for the privilege of using our 20,000. After 5 years, you paid us 28,000, but your car's worth 10, maybe, depending on other market situations. So, it's not necessarily a bad thing. It's being aware, being a knowledgeable borrower. You may pay less, but at least you know the trouble you're getting yourself in. The worst part is people get themselves in all this trouble and they're not knowledgeable. And I'd rather help cure the ignorance of that and recognize that what you may be doing may not be for your best financial interest. And so just being aware helps you make better decisions.
Yeah, and for buying a car, I never negotiate on payment. And I never tell them what I want my payment to be, because they'll fit the payments and the trade-ins and the this and the that to get to your payment. The real question is, what is my total cost of the car? Right?
Yeah.
So it doesn't matter necessarily what your payment is. A lot of people are payment shoppers. I know I need a payment of $500 a month or whatever it is. And then once you tell the car dealer that, they're like, great, now I can put this guy in whatever car, as long as I get him to $500 a month, or I'll stretch out the payments and I'll hide numbers and I'll do this and that. It does not, to me, it doesn't matter what the payment is. Obviously, everybody has a budget, but you want to know what the final number is that you're going to be paying for that car, because that's the important thing.
And sometimes you're in such a desperate spot, it doesn't matter what it is. But, and I won't say they're going to be hidden numbers, but they're going to stretch the terms. Like you thought you might have had a 5-year loan. No, it's an 8-year loan. You just realize, and they're going to disclose everything, but they got you your payment. But don't forget, when you have a car that has a loan against it, you also have car insurance that requires comprehensive and collision coverage, because you have to protect the lender on that, because they're the ones that be on the hook on that. You might even want gap insurance just in case there's a difference. If you get into an accident, make sure that old car loan is paid off so that you can get a new one without taking the old balance into the new loan. There's all kinds of things. So I want to share, this is a great resource. I don't use it all that much, but it's called Dinkytown. I don't know where they came up with that name. It's the stupidest name, but these have some great financial calculators on there. And there's all kinds of stuff that's on here. And so, for example, auto calculators, you could just throw the numbers in, and there's all kinds of different versions of them. But let's just look at, I don't need a boat loan calculator. Gee whiz. Where are we at here? Not really, just a car loan calculator. There it is. And you could put it in, let's say we're looking at $30,000. And that's the monthly payment based on 60 months. So that's $700. But you know what? That's way too much, including the cost of insurance and everything. So let's say we make it 84 months. That's 7 years. And that's $553. That's a little bit better. But even if they might raise the interest rate, let's make it 15%. It all depends on who you're doing business with, who the lender's going to be. If you could qualify for, like, Toyota Financial is a different lender than the credit union. But the credit union might still be better. It all depends on the type of car, the financing, all of it. So this helps you kind of figure that out. And then you scroll down, you can see how much is paying interest and how much is the principal balance. And you can even see, I think we scroll. No, there is. Maybe click view report. Maybe that's where it's at. So there's all the terms and car payments. There it is. So your payment $614. Out of that, you're only paying $216 in principal, which means you're paying essentially $400 of interest. And again, it's not necessarily bad. It's just the truth of what you've got yourself into. Just recognize that it's there. That's how they're structured. So over the entire time,
this is true with a mortgage too, right? So scroll back down there. So when you're looking at the principal versus interest, the longer you go into the loan, as he just gets rid of my screen.
Sorry.
The longer you go into the loan, you can see there's more going towards the principal basically every month. And so,
and it's so incremental. It's small, but over time it will be more principal than interest. but the bank, they, whoever the financer is, they're going to get their money first.
Yeah, they want their money up front. And
It's exactly the same thing as a mortgage. I could go back.
Yeah. Well, here well, never mind. Don't listen to me.
All calculators. Okay, now invest mortgage calculators. Here we go. And let's just look for 20 versus 30-year mortgage. That's always fun. Now, remember, we already talked about the fact that the longer mortgage, it makes far more sense than the 15-year mortgage. So we have a whole other podcast where we dispute that. But let's look at a mortgage of $500,000. Your marginal tax rate. Let's just say that we're in the 22. That's fine. Okay, interest rate for 20. Yeah, 7's about right. There's always a discount of interest from a 20 versus a 30.
Right.
So your 20-year payment is $38.76. Your 30-year payment, basically $3,500. We're looking at a $400 difference per month. And that might not be a whole lot, or it might be everything. It just depends. But just being knowledgeable how that works. And we scrolled. Oh, we got to view the report here. And this is where it's really fun. Year. This is done by year, not by month. But so for the year, you're paying $46,500, $34,600 of interest. And and a less thought of it might be, you mean we're paying $35,000 for their $46,000 this month? No, you're paying the $34,000 for their $500,000 for the whole thing. So it's.
And as you go on, right, you see that number gets lower and lower and lower.
Mm-hmm. So that by the time you got to the 30-year mark, you thought, well, I had this interest rate deduction. Well, your interest is almost nothing.
It is nothing.
Oh, that's a 20. Yeah, it is nothing. So 20 versus 30. So 20 years, it's paid off by year 30. And then in year 30, $1,600, that's not much of an interest rate, the tax deduction there.
Right.
So it's just being knowledgeable about that. Now, how can we build credit when we've had damaged credit and maybe we've done too many inquiries and all that stuff? You may not know this. In fact, most people don't know this about me, and I'm going to share my screen here. I was a forum moderator for creditinfocenter.com. They had a discussion forum on credit matters and things. And so I was involved on a lot of this stuff, just watching other people, figuring out how to clear collections, how to deal with their credit reports, dealing with all this stuff, including, if they pay off an old collection, it could re-age the collection. So it takes longer for it to fall off. So sometimes it doesn't make credit report sense to make a payment on an old collection. The strange things that are out there, but sometimes you got to make the best decision. Sometimes the best decision is leave it alone. It already went to collections. You're done. So anyway, this is, I had to leave the thing because I was involved with a securities firm and they wanted to monitor everything you do online. So I left. But I'm going to share this tab because this was February 2005. So almost 20 years ago, I wrote this, and we're talking about the thread is called "Make Money, Rebuild Credit, and Build Your Savings Accounts."
Hey, I'll be right back. I got it. I'll be right back.
All right. Well, I could go on a monologue. That's fine. Okay. So
yeah, I figured you could do that since you were pulling this up. So I'll be right back.
All right. Okay. So make money, rebuild credit, and rebuild your savings account. So I thought, what can we do on all this stuff? So I was working on some ideas for people like me at the time. Didn't want more credit cards, but I need ideas to build credit. I found a way to build credit without a credit check, and you could build up your savings account balances as well. And if you do it right, you can make money. So instead of paying interest, you'll be earning interest, which sounds wonderful, right? Now, this idea evolves the use of secured loans. Basically, you need to start with some money. Think about getting a secured card, but without the high rate of interest or annual fees. So step one was to set up a CD account. Remember, CD is a certificate of certificate of deposit. It's a time account with a bank or credit union. Now, I chose at the time Digital Credit Union. They're based out of Marlborough, Massachusetts. They offered CDs as low as $500. You can open up a CD for $500. And at that time, when I'm writing this, their CD rate for 12-month term was 2.32%. Not much. You're not going to earn a whole lot. Now, you take out a loan against the CD. They allow you to borrow against your own asset without a credit check. and they're going to report your loan activity. So you're going to borrow out the $500 and maybe make payments of $80 a month, right? After 6 months, you pay it back. It's all done with a little bit of interest because there is an interest rate you pay. It's 2.5% above the CD rate. So it earns 2.32. They're charging you 2.5 plus 2.32. Where could you put that money? You borrowed the money out, but you don't really need it, right? You're borrowing the credit union's money backed by yours. You have this $500. Where do you put it? And at the time, there's a company called ING Direct. I don't think they're around anymore. I think they were absorbed into Capital One online banking. I think it's something like that. At the time, their interest rate was 2.6. So that's 0.1 over what I would be paying. So you use this money, the money that you borrowed, to make the payments back. So the summary is your CD earns money. You borrow the money for the additional 2.5% on top of the CD rate. You invest the borrowed money. I use the word invest just to set the money aside. But the funds in ING Direct Savings Account at 2.6, and you're making money. You're making 0.1 on the whole thing. So I chose Digital Credit Union because the borrowing rate is only 2.5% above the CD rate. Patelco is another credit union that did it for a little bit less at 2.25. The second reason is more powerful. You can always add to the CD balance. That part is neat at any time as long as you contribute $100 or more and your CD term is 12 months or less. That allows you to save more aggressively, which also means it's easier to reborrow the money at higher balances. Keep in mind, you're only using the borrowed money to repay back this loan. If your ongoing cash flow still has room for additional savings, you can still contribute to your CD every month for $100 plus. And I plan to do this for $1,000, $2,500, $5,000, up to $15,000. Just keep your loan for 6 months at a time. And of course, interest rates can change at any time. Guys, I thought about all this stuff 20 years ago. Why do you think I love how cash value life insurance works? The difference is the purpose of this is to build your credit at a lowest cost possible. The purpose of using life insurance is to build up your retirement savings and use your money at the same time and not have it be reported at all. So there's different purposes. That's why I gravitated to it so much as soon as I heard it. And I did my own in-depth thinking about it. And like, wow, that can work. So yeah, I've always had my mind on how can I use my money in multiple places at the same time. This is one for building your credit. The other one is for building your wealth and retirement savings. Now, one guy, and I didn't know this at the time, I was so new on this, but he said, well, what if you have a tax situation? If you really have a tax situation of 0.1% of earnings, you have a far better situation than most people have. So I don't think it's a real consideration. I don't think you can even get much of a tax form past, I don't know, $25. I don't even remember. But anyway, there's a whole bunch of talking about that at the time. And that was 20 years ago. So I share that just to say there's a way to do it without impacting your credit scores, a way to be responsible with it if you're going to be disciplined. You can build up your credit and you just have to use your own money to do it. So with that in mind, let's see. Trump also promised, we haven't seen this one yet, tax deductible interest on car loans. If you have to pay interest, you're already in a bad situation in a way to begin with. But if you're going to pay it, might as well get, an interest rate deduction based on your taxes. May not make sense because you've got to have a whole lot of other income to pass the standard deduction. That's a whole nother thing. We'll see how that plays out because we haven't touched that one yet in the news. But don't let the tax tail wag the purchasing decisions and getting into debt. That's a big issue right there. So, don't say, hey, I can get a tax deduction. Let me go ahead and borrow a whole bunch of money. No. Don't do that. Poor idea of trying to use some tax advice. We already talked about this, is that, if you're going to have a car loan for over 5 years, you need a quality car that's going to last that long. After 5 years, you're going to have more pricey maintenance and repairs no matter the car you buy, replacing brake pads and rotors, replacing belts, replacing tires, just to make sure your car continues to run well as it should. And remember, you can't borrow back from the same lender you sent your money to. They're not going to re-lend you, although there are credit unions that will let you refinance it and take cash out on it. Just keep in mind, what's the habit you're getting into? What's the pattern that you're establishing for yourself? That's a problem. But always make sure that, for me, maintenance is always cheaper than repair or replacement. Just maintain everything as long as you've got a car that's worth maintaining. I think I covered this pretty well. A lot of rules of thumbs, a lot of ways of handling credit issues, just being aware of how borrowing works. So hopefully people can use this information, use the calculators available, and make informed quality decisions for when you do borrow. Because sometimes there's no other choice. You've got to borrow. And if you've got to borrow, make sure you do so wisely. You understand the implications of the borrowing decisions you make, not just the wealth building decisions you make. And hopefully, I think the biggest thing is get a car that's worth borrowing for.
Well, and not all debt is bad debt.
Right.
So there can be good debt. And but when you're just, like we talked about before, borrowing money to buy things that you don't need or borrowing more than you can afford to pay back, that's where the problems come in. But not all debt.
Or bigger problems.
Yeah, right. But that can be used as a good thing at times if used properly.
Yeah, and so if you're looking for our advice on which kind of car to get, I know that you drive a Toyota and I drive a Lexus, which is a Toyota product.
Same thing.
So I'm just saying. Now, keep in mind that I actually have the most unreliable Lexus when you compare it with the entire Lexus line and entire Lexus history. But when you compare that Lexus LS to a Mercedes S-Class or a BMW 7 Series or an Audi, I think it's an A8 or something, it's the most reliable of those. So
I have had a 7 Series. I've had a 5 Series, and I can attest to the fact that they are not the most reliable vehicles, and they do cost an arm and a leg to fix.
I'm glad you weren't amputated for them. Okay. We're talking literally an arm and a leg. There's all kinds of things. So making wise decisions. I mean, if you're going to go into debt, get a good car that's worth being in debt for, that will take as good care of you as you will take care of it. I can't think of anything else right now. But yes, curbing our spending and things like that. I still want people to enjoy life. But at the same time, make wise decisions. Is there another way to enjoy life without spending as much? There's always some great stuff that's out there, whatever that's going to look like. I was like, what does that mean? Bavarian Money Wasters. Okay, BMW. Got it. Okay. It took me a second. Anyway, guys, I think that'll cover it. Maybe, I don't know, next week we either do week 4 or maybe we'll do a break and we'll have a current events show. Either way, we'll figure out. But we'll be back again next week. Y'all have, make it a great day and don't do anything stupid.
Don't forget to like, share, subscribe.
Share, subscribe, comment. Although we've turned off comments a lot because I keep getting too much spam and I'm so tired of the spam posts. So
especially from Alonzo.
No, he's not the spammer. No, I get ones that are talking about the crypto. Thanks for the great advice. I've got this crypto with the key phrase, and can you help me to transfer it to Binance? I'm like, gee whiz. Give me a break. Thank you, Alonzo. Absolutely. Thank you. Appreciate you.
Absolutely, Alonzo. We love having you, Alonzo.
Yeah, in fact, we really got to have him on here.
Well. I keep telling him that we'll get him on, and so he's been waiting, but we will do it.
We'll figure it out. Let me know when we will get this done. We got to have him on. We'll have a spotlight show on him. Anyway, catch you all next time. Thanks for watching and listening. Make it a great day.
You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you
So, ladies and gentlemen, that's going to be the show for today. What happened with my beat?
They call me
I don't know what happened. All right. So, ladies and gentlemen, that's going to be it for today. It's been your boy, the insurance junkie, your fiduciary fella, the all-star advisor on for all your social media and eventually, I will go on the podcast. Our schedules just happen to align. Thank you guys for any questions that you do ask. When you see these guys, please come up with questions. I've learned a lot from them. They've learned a lot from me. We learn a lot from each other. We do belong in a good session with each other. So that's what's good. That being said, ladies and gentlemen, make sure to hit that like, drop a comment, subscribe, and hit that notification where every time I release content. And as always, share. Lastly, to contribute to channel growth, what is with a licensed financial professional, in this video. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and success. And remember, folks, when people challenge you, they don't challenge you. When they challenge you, challenge you.